Not that we repaid any of it, just that the economy gradually grew to dwarf it. Whether for a family or a business, or in this case a nation, having a low debt ratio is healthy. It gives you wiggle room if you ever run into trouble like a recession and need to borrow. Indeed, that had long been the big idea, that in bad times governments should lean into the wind and run deficits, borrowing to boost demand and ease the pain while excess business inventories were gradually worked down, and then, in good times, not borrow much or even run a surplus to build borrowing capacity back up. Yet, in the mostly good years since 1980, our national debt has ballooned. From 30% when the Reagan-Bush team took over, it topped 100% in the fiscal year Bush 43 passed it on to his successor, and 125% in the fiscal year Trump passed it on to his. Only between Bush Sr. and Jr. was the annual deficit tamed, as Clinton handed off what fortune called surpluses as far as the eye could see, and then again when Obama handed off a debt shrinking relative to the economy as a whole. And then COVID. At least by traditional standards, a newish theory called modern monetary theory argues those standards need not apply. The wiggle room is largely gone. I wrote in this space 10 years ago with the unemployment rate hovering just under 10% and home foreclosure rates peaking, we will get through this and emerge more prosperous than ever. But the decade ahead will be more about hunkering down and retooling than about jet skis and champagne. That proved largely true, except for the very wealthiest among us, for whom the champagne flowed like never before. As I write this, the stock market has quintupled from its March 2009 low, so we did get through it. Even so, the nation's infrastructure has been allowed to decay badly. The national debt may require 35 years to shrink back to 30% of GDP, as it gradually did in the 35 years following World War II. And many of the new jobs don't pay nearly as well as the ones they've replaced. The divisions we face are troubling. The climate challenge is enormous. And yet, whether it's the Civil War, the Spanish flu, the Depression, World War II, the Vietnam era, Y2K, remember that one, 9/11 or COVID, the beat goes on. And over time, good money habits and sensible investing have generally paid off. Interest rates. In 1981, Uncle Sam said, "Lend me $1,000 for 2 years, and I'll pay you $336 in interest." In 2021, before rates finally started to rise a bit, Uncle Sam was saying, "Lend me that same $1,000, and I'll pay you $4. And people were rushing to take it. So it's a very different world. In 1981, investors willing to take a risk on stocks or long-term bonds knew that if inflation didn't spin entirely out of control, interest rates would eventually fall, making the prices of both stocks and bonds rise. In 2022, investors have to understand that whatever may come first, interest rates eventually will rise, making bond prices fall. Chapter 5. And stocks relatively less attractive as well. The more interest you can get from safe bonds, the less reason to take a risk with stocks. None of this is to say stocks can't go up if interest rates do. They absolutely can if rates don't go too high and sit atop healthy economic growth. But as a general rule, falling rates boost profits and stock prices. And for nearly 35 years, long-term interest rates generally were falling. Wind beneath the market's sails. At this point, if rates were to start falling again in any major way, it would only be because economic conditions are terrible, and that's not likely to drive enthusiasm for stocks. So either way, up or down, we face a bit of a headwind. The good stuff.